Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, September 12th, 5:13 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we're in the process of a bear market bounce. We upgraded 2 time frames. If you see over here on the trend gauge, leaders still at neutral, with the arrow pointing to positive. Short term, we upgraded from neutral to, from downtrend to neutral. Medium term, also from downtrend to neutral, with the arrow pointing to green, and in both cases also. Long term, we're still under the 200-day moving average, so we are trending still in a bearish slash downtrend mode long term. So what happened today? Day 4, up again, a second straight gap up. Thinking it's time for a pause. I'll show you why I think that when we get to the charts. Strong day, nice close, gap up. It held. Any pullbacks were bought during the day. G6, this is our growth composite, up 1.05% on the day. S&P 500 up 1.06%. NASDAQ 100 up 1.2%. Dow up 0.7%. Mid caps up 1%. Russell 2000 small caps up 1.2%. Global diversified 60/40 stock bond index up 0.8% on the day. In-house, our flagship GROTECTION portfolio up 0.64% on the day. Let's get into the charts, and let's get into my explanation of what we do here at Revere as I shrink a few boxes here. Bear with me for 1 second. New laptop today, so things aren't as crisp as normal. Okay, so here is, let me get this back up here. So here is the S&P 500. Basically what we do at Revere is take a look at how the major indexes are trending across 3 time frames. The green line is a 21-day exponential moving average. That's our short term. The red line is the 50-day moving average. That's our medium term. The black line is the 200-day moving average. That's our long term. Situations like where we were last November, where we're trending above all 3 and they're stacked the way we want them to be, with short above medium, medium above long. We are as long as we can comfortably be in the market. We start going sideways, or if we start to roll over, we start reducing exposure. Quite simply, our stops in all of our individual positions will start taking us out of the market. And if we really roll over hard and the slope of the lines start to go on the moving averages, start to go lower, such as happened mid-January here, and then if we break below the 200-day moving average, we're going to be completely out of the market, or in a maximum defensive posture using hedges to make sure that we're not going any lower. And the reason for that is this lovely graphic here. This is a list of drawdowns and what can happen during severe bear markets. You do not want to get caught as you approach retirement in one of these severe drawdowns. It just takes too long to come back. The average of the last 6, there we go. The average of the last 6 severe bear markets down 44.5% means it takes 80% gain to get back to even. If you're approaching retirement, you just don't have time to deal with something like that. That's why our priority 1 here at Revere is to protect your downside. And what it allows is for us to compound from a higher capital base. If you only lose 12%, instead of losing 50%, you're way higher when the market starts to go back up. And then we use short-term indicators to get us back in. Short-term and medium-term, like for example, here we got back in mid-July, and rode this entire move higher. We got back above the 21, the slope of the line curved up, we got back above the 50-day moving average, and we just climbed it, let it climb higher, stuck with it. Eventually we ran into the downtrending 200-day moving average. That's as high as we went. We started lightening up support as we bounced lower off of that. And this was Jerome Powell's speech day on 8/26. We ended up going to mostly cash that day, getting out of the market. Now, since then, we've bounced at this 3,900 level. If you've been listening to us in the videos, this was an undercut and a failure to go lower day. So an undercut and reclaim, very similar to what happened here on 7/14. On 7/14, we undercut this key 3730-ish level down to 3721, but closed at the top of the range. That was it. Market was done going down at that point. And so far, based on the action in the last 4 days, the market exhausted itself on 9/6 also. So now we have gotten back in. Big day for us was on Friday when we got back above the 50-day and the 21-day moving average. We added a lot of exposure on this day, followed through to the upside on a gap today. Let's take a look at why I think it might be time for a trend here on this 5-minute chart here. Here's our gap up. We immediately went to the upside to 41.20 within the first 30 minutes, and then we just based sideways inside this opening 60-minute range for the entire rest of the day. We tried to break down below it here around noontime, bounced right off of it, tried twice, bounced right off of it. Couldn't get back above 41.12, which was inside the 60-minute range. Same spot we tried at around 11:30 Eastern time today. So this is just coiling and tightening. When you form a base like this after a move, and in this case 4 days up, let's go to a 30-minute chart here. You can see us. Here's where we bottom. Here's that false breakdown. It wasn't the best close that day, but we followed up with a strong trend up day, and this was September 7th. This was this was after Labor Day. What happens after Labor Day? All the traders come back from their for the big Wall Street firms, they come back from their vacations in the Hamptons, and they got to decide how they're going to position themselves. And it looks like, based on what's going on over the last 4 days, they're trying to play catch up with the market, because the market has pretty much had a solid bid each of the last 4 days. Anytime we tried to sell off back below, for example, gap down on the 8th, and immediately it recovered. Tried to sell off midday, immediately it recovered. And then we had a gap up on this last Friday, another gap up today. Now going sideways inside this range. Might be time for a break. If you go to the daily chart, you can see we're above the moving averages. Any pullbacks want to be contained by Friday's lows, very critical. That's around the 40-20 area. The 50-day moving average is working its way above that. So any pullbacks ideally are contained by the 21-day moving average, but I'm not going to panic if they undercut and hold by the 50-day moving average, just because of how strong this move has been over the last 4 days. You'll notice the stochastics have turned up. That's a good sign for the overall indexes. And let's go to the rest of the indexes. Here's the NASDAQ 100. Same situation, one close above the 21 and the 50-day moving average here. So we want to get our second close above there. Stochastics pointing up. Dow Jones Industrial Average, one close above. Want to make sure that today's lows hold at worst. This 32,000 area needs to hold on the Dow. Mid-cap's a little bit stronger. Further above, coming into the 200-day moving average. Notice mid-caps got above the 200 days for a couple of days back in August before we rolled over. Now we're less than 1.5% away from the 200-day moving average on the mid-cap index. The small-cap index, 2.8% away. But again, multiple closes above the 21 and above the 50-day there. So that's the reason for the improvement in our trend gauge. And we're also seeing some pretty decent action in individual names. Let's take a look at the tail of the tape and I'll go through that, point out the changes. Tailwinds, indexes in the G6 all had daily stochastic crosses up. In fact, take a look at this snapshot that Michael provided to me from Thinkorswim. This is a composite of the G6. If you're in Thinkorswim, all you got to do is in the ticker box put in all 6 of the tickers separated by a plus sign on each of them. It generates a chart for them. You can see the G6 above the 8 and the 21-day moving average. That's the purple line and the blue line here. Second close above, that's the 150-day moving average, which we're coming into here. So we have had participation by growth stocks over the last 6 days. This is what we want to see, and you can see it in individual names too. The leaders of the 21 over 21 list holding up pretty well. So we're still battling back and forth between this bear case and bull case. I'm not ready to punt on what's left of the bear case, primarily because we haven't gotten above, sustained above the 50 and the 21 on by the NASDAQ 100 and the Dow. I want all the indexes above it, and before we formally give up and go to say that we're in the full bear case, not to mention that after 4 days up, we're also due for a little bit of a pullback. So some news tomorrow morning, we've got CPI, very closely watched inflation gauge. This will move the markets. Expect volatility before the open and after the open. Some news today, the New York Fed said consumer inflation expectations fell to a 10-month low, 5.75%. They were over 6% the prior month. So the market got a little bit of a bump when that came out. As far as notes today, we went from a day up 3 to a gap on up 4. Nice close. We held up all day, so more positives for the market. My expectations were neutral to positive after 3 days up coming in. We ended up with a 4th day up. But as I mentioned, that tight coil inside of the opening 60-minute range today, we want to see how that resolves. Consolidation should resolve to the upside. Otherwise, it's a change of character. We got above this resistance 1 level in the S&P, 40.80. Our high today was 41.19, so 40.20 for now. Was rejected, so that's going to stay as resistance going into tomorrow. On the NASDAQ 100, we gapped above this 306, 307 area, still close below this 313 resistance area. Let's see what other highlights we have today. 11 out of 11 sectors higher, so broad participation, which is what you want to see. Oils led early, cloud and cyber stocks led. Early weakness on biotechs, solar, and semiconductors. They all ended up positive during the day, less than the indexes, which are why they're not green. They're in a neutral color, but nice bounce back by the key solar stocks and some biotechs. We're looking at a possible break of resistance on the biotech index XBI. On the downside, the dollar down for the 4th day, and this continues to be in sync with what's going on with the markets. Big negative reversal on 9.7 in the dollar. This started the move higher in the market. So this inverse correlation still happening. And for now, it's a failed breakout from this base on UUP, which is the US dollar. Let's see what else was negative. Bonds down, which means interest rates are higher. Uranium down on the day, but CCJ managed to end up with a positive close. Fertilizer stocks took a beating today. So focus list, let's take a look at some of those stocks on that list. But first, let's point out the key levels that we're looking at. We're inside this 40.80 to 41.20 range. This served as a battleground for support and resistance going all the way back to May. Inside that range now, we need to break above 41.20, and then we come into the declining 150-day moving average. And then next level up is this COVID rally fib, 41.99, 4,200, which we broke below at the end of August. So you can see the levels laid out here in the tail of the tape. Let's get to what our focus charts were coming into today and see how they held up. Lithium had a downgrade, LTHM. This is Live and Corp, had a downgrade pre-market. Let's take a look at a 5-minute chart on this, and you tell me how this ended up closing. There's your gap down undercut within the first couple of minutes, and then just a slow grind higher the rest of the day. A very positive bar for LTHM, didn't even make it down to the 21-day moving average. After 3 strong days up and a negative reversal on Friday, this is positive, puts in a short-term bottom above the 21-day exponential moving average, which will catch up to that bottom over the next couple of days. Next was CMG. I've been talking about this forever, still haven't bought it, but 7 days up for Chipotle now, break above this handle, above average volume or right at average volume for 5, 6, 7 straight days, 5 out of 7 straight days, very clearly being accumulated, as you can tell by the relative strength line also. Also Celsius, I noticed last week that this had reclaimed some strength, getting back above the 21 with a little bit of volume after this 7-day sell-off. Early leader of this recent bull market just came down to the bottom of this range, so very strong support at this 50-day moving average. It's now 14% above that, only 4% above its 21. So Celsius added to the list. And then the stocks that I've really been focusing on to see if we were going to maintain strength. I talked about Enphase being the canary in the coal mine with this breakout last Wednesday. And then it got a big downgrade, but finished at near the top of the range, or in the upper half of the range anyway, on Friday, which was very constructive. That 300 level, as you can see, was resistance on the way up. Broken on Wednesday, tested, and the 21 also held. A nice day today for Enphase. We own this. We're looking to add to our initial quarter position that we took. Other stocks we were looking at, First Solar continues to act very well. Another one that gapped below Friday's low on the day, finished right near the top of the day, continues to be extremely strong. And then the two canaries in the coal mine from leadership perspective, Tesla got above its 200-day moving average for the second day today. When it got back above this 300 level, we took a position in this morning, a quarter-size position. And then Apple was just ridiculously strong all day. We bought 5% right off the bat with this as it gapped above 3 moving averages and just was grinding higher all day. You see this nice little tight flag that it put in the morning, broke out of that, and then the back test here held, and then it just trudged higher for the rest of the day. So while the indexes, the S&P 500, let's look at that specifically, not making highs on the day, Apple was. And keep in mind, Apple led this last leg up very obviously. Started off before earnings with its gap up on earnings, back tested the 200-day moving average. Note the relative strength going all the way back to June for Apple. Took a break now over these last 4 weeks, broke below its moving averages, had a false breakdown on Thursday, but now buyers in a big way came into it today, taking it above the 50-day, the 21, and the 200-day moving average, and we took our position. So those were our 2 buys on the day. That took our adjusted beta from 0.71 to 0.85, 59% cash. Bottom line on the day, day 4 gap upheld, basing inside the opening 60-minute range for the rest of the day indicated might be time for a pause. So need to watch closely to see how that resolves tomorrow. ENVX was a standout today. Let's take a look at that. This was also a leader with this earnings gap up, and every time it's come down and tested it, the test has been the low of that gap up day, and it's holding. Good sign here for this one. I want to make sure that this gets on my watch list. Trades 4 million shares a day of a $22 stock, so very close to our $100 million threshold in daily dollar volume. If we get into it, we just need to take a slightly smaller position, but good stuff here by ENVX. And that's going to wrap it. As always, if you like what you see here, reach out to us. We'd like to talk to you about becoming a client. You can email me, don@revereasset.com, or you can phone 855-REAL-WEALTH. That's 855-732-5932. Danny Stewart will answer that, and he'd love to answer any of your financial questions. So wrapping up Monday, September 12th. This is Don Vandenbord telling it like it is. Remember, it's not how much you make in the market, it's how much you keep. Thanks for listening and have a great day.